Hey traders, this is Blake Morrow with Traders Summit. And with me today, I have Mr. David Belle. First time, he is the founder of Macrodesiac. Good to see you, David.
Hi, Blake. How are you, mate?
I'm doing great. And, it's interesting. I find it interesting that I've been following you probably for the last year or so on Twitter, and I find your conversations extremely insightful. And I'm excited to hear about you. And I want, all the traders from the Traders Summit community to really know who you are as well. So tell us a little bit about yourself and what you do.
If you haven't seen me on Twitter, I'm quite a loud and relatively brash personality when it comes to markets, and I do like to take the piss, but also be very self-deprecating as well. I started trading when I was started trading when I was 17. I was doing my A-levels, searching things on YouTube like interest rates, stock markets, that kind of stuff, because I was doing A-level economics, and naturally the advertising algorithm caught up with me. I got a brokerage advert that said, trade a 10 grand free account or something like this. Great. Opened the account on demo, traded it up to like $1 million or something like this. Can't remember the specifics. A couple of months later, when I turned 18, opened up a real account with $1 grand, lost that in a couple of days because I pretty much considered demo as being the same as live. Didn't understand risk management, anything like that. Went to university. Had a lot of arguments with my lecturers and my seminar tutors over things like whether QE was inflationary or deflationary. And this kind of started off my cynicism and a bit of my my intrigue as to what is right out there and what is wrong. Obviously at the time the unconventional monetary policy was coming in. Everyone thought it'd be massively inflationary because it's money printing, right? Well, it's not really, if you actually look at how the mechanism works. Then after university, went to work at a retail brokerage, which was massively insightful because you get to see what the average retail person is doing wrong. And from there, you just reverse engineer things to come to the conclusion that all retail traders that are consistently losing, what they do wrong is use too much leverage and trade too often.
Isn't that the truth? That's the truth.
Absolutely.
Yeah.
Trade too big, and it just comes down to not being able to pick your battles is probably the easiest way to put it. Then went to work for a mid-market brokerage, started putting stuff on LinkedIn every day, and people that were, more experienced than I am at the time, older people with a higher pedigree. They were chatting to me as if I was their peer in terms of the ideas that I was putting out. What I was able to deduce from the market and things like that. And, I didn't really take it as me being very smart. I kind of took it as, okay, this is kind of just my view, nothing egotistical about it or anything like that. From there, I launched Macrodesiac after leaving that firm, because I found that the macro is quite either incoherent or sort of unobtainable to the average retail guy. A lot of the time they start off with the technicals, which is fine, but then they're convinced that only going technical is the right way. And then obviously there's a big sort of chasm between the macro stuff and trying to decipher it and what you should prioritize at each point, versus just using technicals alone. So really it's putting stuff into a conversational tone, sometimes swearing, chatting as if you're down the pub with your mates, really, because I think that resonates a lot more and is more relatable. If you can put something that's quite high level into a way that people are, firstly enjoying reading it, and secondly, it's easy to understand and easy to read, that makes that kind of differential a lot tighter, right? So, and I'm talking about between obviously the high level macro stuff and the language used. So that's really the aim of what I've been doing over the last couple of years, and obviously naturally trading alongside it, but trading a lot less frequently. I've realized that day trading is absolutely not for me. I am awful at day trading, and my strengths lie in really picking my battles well. I think that is really, really what I'm good at.
Well, that's I find that fascinating to hear from somebody who's probably tried it all over the last 10 years or so, and you've really come to a point where I think a lot of traders, especially starting out, come to that conclusion. It's like, hey, I understand technicals, and I kind of understand why I'm buying, why I'm selling when I'm looking at it, but I don't really understand the mechanics behind why I'm actually doing it. And as you said, the chasm or bridging that gap, I think is the reason why people have a real fondness for understanding the macro point of view from people like yourself and others that can help them have a basis or a theme that they're trading with in conjunction with using technicals to help precision entry their way into the market, right?
Yeah, absolutely. And I think the thing with macro is that it's less about understanding everything and more about trying to focus on, okay, what is the duration of this idea? How should you prioritize this, functional or factor in the market versus another one? And rather than trying to literally understand so many different flows and whatever, take a worldview, take a single view of a certain period, and then try and attach an asset class which you think is going to have an outsized move within that period. That's the way that I go about it. Well, rather than trying to, look at what euro dollars do and then form an opinion as to why it should go up or down.
Yeah.
I do it the reverse way. And I always think that starting reverse is better because most people don't do it.
Well, sense. Yeah, most people are like weatherman analysis, right?
Exactly.
Look, it's cloudy with a sprinkle of meatballs. So people try to figure out why it's cloudy instead of understanding why it just became that way. Correct?
Yeah.
Exactly. Yeah, well, that's going to turn us into the conversation that we wanted to discuss, or you wanted to discuss today, a little bit about inflation, because obviously that's the hot topic that traders are trying to grapple, or their heads around, and really have been for the last 6 months. I mean, obviously 6 months to a year, I should say, all of 2021. Here we are, really, the not only people, I say, the general public at large, but really traders and economists are really grappling with the idea that inflation is maybe it's not so transitory. So what are your ideas about the inflationary environment, and how do you frame it?
So I've always considered that we've been in a very anomalous period over the last 2 years, right? And even when it comes down to the business cycle, in 2019, we started to see the business cycle drop towards towards Q4. And then we had this weird thing happen where governments pumped trillions of dollars into the hands of people, right? We didn't have a real recession in 2020 or 2021. We didn't. There was a period of negative growth over those 2 quarters, but it wasn't a real recession. No one's houses really got lost. Even now people are willing to quit their jobs, but people are willing to quit their jobs, not forced to. They actually want to. It was 4.5 million, I think, at the last reading in November, in terms of people that just quit their jobs. So this is one way in which I've started to frame this inflation debate. And alongside that, we had one of the biggest disruptions to supply chains ever. We've seen a massive change in behavior in terms of what people were buying. Durable goods went bid massively. Containers were turning around empty into LA and New York because people were buying so much stuff from China just to satisfy themselves while they were locked down, while they couldn't go to work. People were buying rubbish. The amount of crap that I bought over lockdown is ridiculous, right? And so we've seen this massive behavioral change, and base effects were a massive thing as well last year, right? I still think we're exhibiting some base effects there, even going into this year. But the way that I've wanted to frame this transitory thing is these are factors in terms of the supply chains that have been so anomalous compared to historical data that you cannot consider them to be a normal view of 2 years, if that makes sense. You can't necessarily keep them as something that will continue into the future. So the way that I've looked at this is, okay, should the Fed raise rates? And the questions that I've asked myself are, how long does it take for monetary policy to feed through to the economy in a developed economy? And there was a paper, luckily, that had studied this. And it came out that in developed economies, it can take between 24 to 50 months for monetary policy to feed through. So the kind of evaluation that I came to there was, okay, if inflation is considered to keep going once rates have risen, okay, then that is a good reason to raise rates, right? Because of that feed through. However, if inflation starts to subside slightly before that feed through occurs, so that 24-month feed through, let's say it could be shorter than that by, you know, let's give a margin of error of even 20%. Okay, so even 20 months to 18 months, let's say, then that is a policy error. And considering this massive anomalous thing that's happened in terms of supply chains and the supply chain block up, then we've got to be considering that surely is the definition of transitory. If inflation dips before the monetary policy effects can take hold, then that is transitory, right? Inflation's slowing down, plateauing, and it's coming down of its own accord, rather than anything to do with the Fed. So that's the way that I've tried to frame it in my head, to give an objective enough view on what I think transitory is.
Well, that's a reasonable explanation. But let me ask you: do you think that the pressures that consumers feel nowadays, whether it's housing, whether it's energy, do you think it's going to be sustained? Maybe the momentum of how fast inflation was moving higher, maybe that will not be transitory. But do you think the price pressures are going to remain elevated?
Well, yeah, there's a difference between price level and inflation, right? So inflation is down to, I guess, velocity, and price level, you know, you can have a one-time increase in the price level, which is the inflation. But then if that doesn't move, then there's 0% inflation, right? Now, obviously, what has to factor in there is wage growth as well, nominal wage growth. That has to catch up and be greater than the inflation rise, obviously. Otherwise, it's a net negative. We have seen, you know, pretty decent wage growth, still slightly below, I think, where it should be. But I think that is kind of all that matters. And from here on in, I do believe that inflation will, you know, start to alleviate. If we look at ISM prices paid yesterday, it was a big miss. That's very heavily correlated with the 5-year break-even inflation rate. So, you know, I think there are signs that it's kind of abating. Now, we're coming into spring as well in the next 2 months, and obviously the energy sector is a big thing on people's minds right now. You know, there's even riots going on in Kazakhstan over the energy prices, petrol prices, and stuff like that. But spring tends to see some alleviation in prices. I mean, Henry Hub nat gas futures are down, you know, pretty heavily from the highs, and I still think that we're going to see some alleviation there. There's been a lot of focus on the Russia pipeline in Europe. Is it the Yamal pipeline? But that only provides 16.5%, even though all of the news stories have been focused on that, which is bizarre to me. And I think it's very much more of a political thing. You know, it's quite emotive talking about Russia almost invading Europe, putting Europe at the behest of their nat gas supplies. But I do really genuinely think that inflation is going to subside from here, because there's two other factors as well, in that firms tend to want to enter into fixed price agreements from here on. They want stability. They want, you know, basically insurance against future price rises. And that in itself, I think, will keep it quite stable too. And then the other thing is that higher prices kind of prevent inflation as well. There only comes a certain point where prices can go so high, right? And then inflation stops. Now, again, we've got to differentiate between price level and inflation, right? The big risk will be if the Fed is tightening into deflation. You know, if we get a big reversion to that mean, where longer term inflation expectations are anchored well. There was a study done by, I think it was Liberty Street Economics, so the NY Fed, that said through 2020 and 2021, long-term inflation expectations were actually really anchored. And if you look from 1991 inflation expectations of the consumer have been very, very anchored, you know, around that 1.5 to 2.5% level, which is perfect. You know, I do think the Fed's average inflation targeting framework has allowed for more wiggle room. But at the end of the day, it's basically them alluding to, we don't really know what's going to happen, in my view as well. But I, unlike many other people, I do think Powell has handled the last 2 years very, very well in terms of his messaging.
So how do you, okay, we talk about, you talk a little bit about energy, but how, and you know, what's going to be happening here over the next, you know, 12 months or so, how does that translate into the markets? Like, how are you going to trade it? How are you going to express your ideas of what you want to do?
Sure. So my view in terms of inflation, I think obviously the one, let's actually not talk about inflation here. Let's talk about demand, because inflation is a byproduct of demand, aggregate demand, if you want to call it that. So to make goods, you need more energy, right? Specifically oil. If you want to transact in the economy, if you want to move goods around, you need oil, right? To do pretty much anything, you need oil. And oil is very tightly correlated with inflation. You know, if the oil price is heading higher due to increased demand or reduced supply, then, you know, inflation is likely to head higher as well, because it's a very inelastic good. So my view is that with this subsidence in demand, you know, we can look at durable goods orders as well, for example. You know, again, bid up massively over the last couple of years. Used cars, for example, you know, they went through the roof. People aren't going to buy these goods much more since they've already, well, done the front loading of buying. You know, you don't buy durable goods much. So I think from that perspective, there could be quite a rapid decline in demand from that perspective, which obviously will impact oil. Now, another factor of this is, what is a currency that's very, very heavily correlated with oil is CAD. I think there's kind of two factors here. So Canada is massively indebted. It's one of the worst situations I've seen. Like, it's similar levels to China, I think, on corporate debt to GDP. That is not a good situation for a currency, in my view. You know, that doesn't imply that a currency should strengthen in those conditions. And also, the economy of Canada isn't as dynamic because of its reliance on oil and wood, I guess. You know, massive exporter of wood as well, or timber, lumber, whatever. And then you've got the counter side to this trade structure as well, which is yen. Yen's had an awful year through 2021. I think it was down like 12.5% or something like that. Now, if you're considering that there might be some reduced demand going on, people might start getting a bit jittery. Now, this is from a sentiment perspective. So you might see flows into yen. Again, a bit of mean reversion. But also off of that, the Bank of Japan actually said something really interesting today, which is abandoning their long-term view on price, saying that the downside risks are less. I can't remember the specifics. I'll have to get the article up. But they actually said that the downside risks to price are now less important than the upside risks. So they might end up abandoning their policy. Now, if the Bank of Japan were to do this, the snapback would be immense in terms of the yen.
Yeah, it'd be viewed as hawkish, right?
Yeah, exactly. So I'm taking those two factors alongside a few other things as well. The chart of CAD yen looks really good. If you look at it from a monthly perspective, there's, you know, it's ticked back up into the 91 level, big downward trend line from 2000. I think it's 2008 or maybe even before. I can get it up here. But yeah, the chart looks good as well. It looks like a good setup.
So, if I'm putting two and two together, you're thinking that crude oil prices might come down a little bit. What's going to be affected most is maybe the Canadian currency to the downside, and you might see some yen strength if you get a little help from the BOJ. So a short kind of, I don't know if I even want to call it counter trend, because we've really been in a big downtrend over years in the Canadian yen. You're looking at this as a possible setup to be short. Is that correct? Is that the way I'm translating it?
Yeah, absolutely.
Oh, okay. Continue on with your technical view of the Canadian yen.
Yeah, so there's there is the big downward trend line, and that's really all I'm focusing on when it comes to technicals. I don't really like to overcomplicate the technicals.
Yeah, good.
But the other aspect as well is obviously what the BOC are sort of saying, because they were pretty bearish, pretty dovish previously in December. They were they didn't want to think that a hike was necessarily available. They didn't want to taper. So I was thinking that I don't really see a way out for the Bank of Canada, considering their debt loads. If they were to raise rates considerably, or not considerably, but 2 or 3 hikes in 2022, I think that would be really, really bad for the amount of debt that they hold, especially for their consumers and the housing market as well.
So you got the BOC at the end of the month on January 26th, which could, I guess if you're thinking about it from a trading perspective, let's say what you say comes to fruition over the next couple of weeks, we could have a pivot here in the next week or two to see a reversal in the Canadian yen. Then, maybe you get a little lucky and you get a more dovish BOC at the end of the month that maybe fuels the fire to the Canadian yen to the downside.
Yeah, hopefully. And I think, with the way that Canadian politics is set up as well, there is the desire for, lockdowns and things like that. There is a desire for mask wearing. So I think the BOC might be hesitant to tighten based off of that as well.
So you think that, we're not talking lockdowns, but we're talking that there could be some sort of government action regarding COVID protocols in the weeks ahead as well.
Yeah, exactly.
All right. Well, David, I just like to keep that kind of option open. I think that is a risk, especially when you talk about certain countries, whether you're talking about Australia and, they've obviously shown their hand about how draconian they can be. I mean, I don't know. I can't foresee the future, but I understand your hesitation with certain economies and certain governments and how they react to COVID protocols, I guess.
Yeah, no, exactly. That's it.
Well, David, I'll tell you what, I think speaking on behalf of myself and probably the rest of the Traders Summit community, really enjoyed this conversation and getting to know you a little bit better. And I know myself, I want to hear more from you. So, but between the next time I bring you back on with Traders Summit, how can and what's the best way for me to follow you?
Yeah, so at David Bell _ on Twitter and Macrodesiac.com.
Awesome. All right. Well, and for traders, you guys listening in, if you like what David's doing, make sure you give him a thumbs up on this YouTube video. If you're watching us on YouTube, subscribe to the channel so you don't miss any of our content. And then also you can click on David's profile down below and you can get a link to Macrodesiac as well. So David, I enjoy following you out there on Twitter. I enjoy this conversation and I look forward to having another one here in the next month or two.
Cheers, Blake. Thanks for having me.
Thanks for being on, Dave. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.